Hey, welcome back to Business 101, Introduction to Business. And in this fourth video of our 12th module on accounting, the topic of accounting, we're looking at, as you can see on the slide, the topic of SOX. No, not the kinds of socks you wear on your feet. SOX as an acronym for Sarbanes-Oxley, which is an important piece of legislation. It's a law that governs modern accounting and results from some of the worst examples of accounting fraud in the history of American business. So buckle your seatbelts. If you're going to understand accounting, you need to understand the importance of SOX in today's language, why it's important to us to remember as businesswomen and businessmen. Buckle up. The first thing we have to know is three company names that predate the legislation, the passing of SOX. These three companies, you see them here, the logos for Enron, WorldCom, and Tyco. These three companies are the reason why we have SOX legislation, so let's start a little story here. Back at the turn of the century, when we get to the year 2000, right after 1999, so the first thing you have to know is the company Tyco, the logo there in the bottom left-hand corner of your screen. The Tyco Corporation committed fraud to the tune of $3 billion. $3 billion of corporate fraud. And as a result, went out of business and then reorganized. The second company, WorldCom, one of the largest telecommunication companies in the United States at that time, which was the early 2000-2001 era, they committed about $4 billion worth of corporate fraud, accounting fraud, and as a result, that CEO went to jail, was sentenced for 25 years in jail. They went bankrupt, eventually were purchased and are by the MCI Corporation, so their assets are still being used as a telecommunications company, but WorldCom went out of business. Now, the last and worst example of accounting fraud, you see there the upper left-hand corner of your screen, the infamous Enron Corporation, an energy company out of Texas. They committed somewhere in the neighborhood, after all the penalties were done, somewhere in the neighborhood of a cost of $74 billion worth of penalties and fraud. Again, let me just repeat that. $74 billion cost of their accounting fraud, and even worse, brought down thousands of jobs, including the demise of one of the top 5 accounting firms in the world, Arthur Andersen, which no longer exists because of the Enron scandal. Innocent people lost their jobs. Many people lost their entire retirement savings because of the accounting fraud of these three companies. After all of these things were exposed in 2001, right around the years 2000 and 2001, we decided we'd had enough. And therefore, legislators in the federal government decided we need greater oversight of the accounting profession and corporate accounting as a total function. And as a result, in 2002, two legislators, Sarbanes and Oxley, co-authored what is known as the Sarbanes-Oxley Act of 2002. And of course, for shorthand, we call it SOX. The textbook offers up the shorthand nickname Sarbox. I got to be honest with you. For all my years in business, I've never heard anybody use the term Sarbox except this textbook. So most people use SOX to refer to Sarbanes-Oxley. And now it's a durable part of the accounting profession because Sarbox or SOX essentially said set new federal regulations to with the aim, at least, of restoring public trust in accounting practices by imposing a whole new set of requirements and regulations and penalties for financial activities in publicly traded corporations. So what are some of the new regulations? Well, we have a table in the textbook, and I've reproduced that here in this slide for you. Here are some of the selected provisions of Sarbanes-Oxley. You can see here, the very first one creates a National Accounting Oversight Board that, among other things, must establish the ethics standards used by CPA firms in preparing audits. It requires that audits auditors retain their working papers for a specific number of years. It requires accounting firms to rotate the actual person who is doing the auditing work, so they prohibit the same person from being the lead auditor for more than 5 years at a time. Because you understand what the implication of that. Folks were getting so cozy with the corporation they were supposed to be an independent auditor for, that the company was able to either tempt them, lure them, or threaten them to turn a blind eye to accounting fraud because they had a relationship built, right? Now, the most important provisions of SOX I've highlighted in red. Let's take the first one up there. The fourth bullet point, the first one highlighted in red, it requires that both the chief executive officer and the chief financial officer personally certify and sign that the company's financial statements are true, fair, and accurate. And if it ends up they have signed and certified that those things were true, fair, and accurate, and it ends up they were lying, they can go to jail. You see there, lower down, those 2 bullet points I've also written in red there, imposes criminal penalties on auditors and clients for falsifying, destroying, altering, or concealing records, and imposes a fine or imprisonment up to 25 years on any person who intentionally defrauds shareholders. Now, those are the ones in red. You see the other ones there on that table. You'll see it in your textbook. But all of a sudden, for the first time, chief officers of the corporation, if they were lying, they could go to jail. And some of them did go to jail. This is the first time in the accounting profession there were these kinds of teeth in regulations and laws. And now, of course, SOX is a durable, normal part of accounting for public corporations. If you're a publicly traded corporation, your audits and financial statements have to adhere to the provisions of Sarbanes-Oxley, or somebody's going to jail. What does that mean for us today? Well, one of the things it actually means on a practical level is that if you're an accounting major and you do a good job, you have a guarantee of lifetime employment. That's one of the things that SOX created, was a multi-billion-dollar need for more accountants, because SOX requires an awful lot of work in order for a company to comply with all the regulations. And so the need for accounting departments doubled or tripled. And therefore, as the size of accounting departments grew, so does the requirement and need for accounting graduates, accounting professionals, for certified accountants to work in those accounting departments. So it did a number of things. It restored the need for ethics to the forefront of the conversation in business. Quite frankly, Sarbanes-Oxley is the reason why every business class in a college or university now has an ethics lecture, and there are entire classes in ethics that are required for business majors to pass in order to graduate with a business degree. Sarbanes-Oxley, and of course the scandals and debacles that preceded it, are the reason why there's a focus on accounting ethics now that there has never been before, at least to this level, and to this level of guaranteeing employment for accounting majors now and in the future to come. I hope that this is great, useful information. It sure is sobering, and it should be for anybody who's a business professional. Hope this is helpful. Thanks so much for your attention. We will see you in the next lecture.